welcome. I am going to introduce Brigitte, who is our staff member here running this Zoomer Boomer program, who will introduce our speaker.
Hi, everyone. Nice to see you all here today. We are a smaller group than usual, but I can introduce our expert for today, Vince Murton. We're a smaller group. I don't know if Vince, you'd like to maybe informally introduce yourself. Feels a little bit formal to read the bio. So
introducing myself is normally half my presentation. It's my favorite topic. Sure. My name is Vince Murton. I own my own financial planning company. I am our financial planning. That comes after about 10 years as an in-house financial planner for a couple of large independent investment firms here in Canada. Really, I'm a big believer. It's kind of funny. I'll talk about this in the presentation, but when it comes to financial planning, it's a lot of technical stuff. It's a lot of tax. It's a lot of calculations, which is exciting for me being a math nerd and boring as hell for everyone else. What I really love about the job, and what I think is the most important part, is that the big challenge is that most people in Canada aren't really familiar with personal finance. We do a terrible job teaching it. There's really no good resources. And I have worked with tons of very successful, very high net worth folks who have no idea how personal finance works, and they feel terrible about it. And that kind of breaks my heart, because we have no resources for people to learn this themselves. So for me, one of the most important parts of my job is taking kind of all of this esoteric information that's really very personal to people, and help kind of formulating it and giving it back to you in a way that you can actually use it and make sense of it and make good decisions. So for me, the best part of my role is a little bit of education and a lot of just, helping you make use of these assets that you've accumulated and understanding what are the good decisions that you can make and what your options are. So that's not really more of a bio, it's more of a manifesto, but it probably gives you pretty much a better idea of who I am than listing the 30 places I've worked in my career.
Excellent. And I think you mentioned that I had taken a little bit out of what you'd said, and that your what was it? I had here your credo. Oh, that's right. Here we go. Information and knowledge for the right decisions.
Yeah, absolutely.
Yeah, I took a look at your bio and I said, okay, what's that one sentence that just kind of says what it is, what you believe in, and how you want to lead your business by, or what your teaching methods are.
Yeah, absolutely. It's easy for me as a planner to take all the information you give me and say, okay, well, here's what I would do if I was in your shoes. But that's not really relevant to you, because you different things might be important to you. And rarely when it comes to finance is there a correct answer. There's almost always a set of trade-offs. And so my job's to help you understand what the trade-offs are, give you the information so you can pick the best solution for yourself. Because it's quite legitimately going to be different than the answer I might pick, or that Alan might pick, or that anyone else might pick. So it's more kind of education and giving people, arming people with the knowledge, rather than, just, oh, here's what you should do, because maybe it isn't what you should do.
And of course, things change over time as well. So
absolutely,
review is important. Okay, so I guess, why don't we get at it and we'll see where we go.
Sounds good. Let's see if I can. Okay, I'm going to try and share my screen, but I think you have to.
Oh, you're right. I forgot to do that from the beginning. There we go.
So Alan taught me earlier today how to share this while keeping my picture on. So if it works, I'll take the credit. And if it doesn't, it was his teaching failure. That's the way I'm supposed to do it, right? I take all the credit.
Yeah, absolutely. There you
There we
go.
go. I think we have success. My disembodied head down at the bottom. Perfect. So the one thing I will ask, because I know this is being recorded for other folks, there will be time for questions at the end. And I'm happy to kind of spend as much time as we need. I would just ask that we hold the questions till the end, just so we can kind of keep the recording fairly tight. And with that, let's get it kicked off. This is financial planning for seniors. My name is Vince Murton. I have a bunch of funny letters after my name. CFP, CLU, TEP. What on earth does that mean? The one you probably care about the most is the CFP, which is the Certified Financial Planner designation. That is kind of, there's a couple of good financial planning designations in Canada. That's the most common one and generally the industry standard. If someone tells you they're a financial planner and they don't have a CFP, as it sits right now, anyone can use the title. Not necessarily everyone has the knowledge. I at least did the homework to get it. So let's look a little bit about what we're going to talk about today. Quick introduction, just where I can talk a little bit about financial planning, what it means, what's the financial planning process. I'm going to talk a bit about preparing for retirement, because I understand the group that we're targeting today will have some folks who haven't retired yet and some who have. So I want to make sure we've got information that's relevant to everybody who could be making use of this. We'll talk about some tax planning concepts, and that will kind of span before and after retirement. And then finally, we'll talk in general about some estate planning ideas. So financial planning, what is it? For my business, financial planning is generally the art, the science of creating a written financial plan. So the way the process works is that I would sit down with somebody. We would do a deep dive into all of their finances, their goals, their objectives, their budgets, when they want to retire, what their assets are, what their concerns are, what their family looks like, what their job looks like, what their business looks like, really so that I can get all the information I need, plug it into my really fancy software, which does about 90% of my job for me, and then produce a report for you that really does the analysis, gives us ideas of, when can we afford to retire? How much can we live off of in retirement? How much do we need to save to meet those goals? What if I have other objectives? For example, I want to leave a certain amount to my children, or I want to put money aside to help one of my kids buy their first home, or I just want to maintain a certain level of savings to make sure I have a safety net. So any question that has kind of a personal finance bent to it, we can plug that into the financial plan and help you get answers for it. A lot of times, as I kind of said in our beginning here, a lot of times there's options. There isn't a static answer. The easy example for that is, what do we do if we don't have enough money for retirement? And I'll get into this a little bit later in the presentation, but there's a bunch of options that you have. And how you weigh those trade-offs is going to be very different for every individual. So what I would try and do in a financial plan is work with my client to help understand how, give them an initial picture, help them understand how the trade-offs work, and then go back and forth to get a plan that is right for them. Who needs financial planning? I would love to kind of half joke that everybody can use a financial plan. That's mostly true. Ironically enough, one of the few situations I've seen of somebody who absolutely did not need a financial plan was my own parents. My mom and my dad was a retired teacher. My mom was a retired nurse. They both had pensions. They owned their home. They were quite happy living off of the pension income that they got. They had a reasonable lifestyle. They didn't do a ton of traveling, didn't have any exotic needs. My brother and I are both self-sufficient. Didn't have any big estate goals. The money came in, they spent the money. The money was guaranteed to come in every month. They were going to spend the money every month. Like I couldn't come up with a reason in my head to get them a financial plan. Pretty much everyone else can probably use one. If you haven't retired yet, understanding why, how you're going to accumulate the amount of assets you need to retire, how much you need to accumulate. I kind of see two different positions with folks like that. One is people who know they haven't saved enough to retire, and what they're really looking for on the plan are, what are my options? How do I get to okay? How do I get a plan that's going to sustain me through my kind of my formative years? The other group are folks who tend to be very good savers, and they kind of have the opposite problem. A lot of times I see this with couples where there's a tension because one of them wants to save everything and one of them wants to spend a bit more. And by putting a financial plan in place, we may say, yeah, you're doing just fine. And in fact, now you've got the information where the two of you can maybe spend a bit more and not have to fight about this because you're both looking at a set of numbers now rather than just having this ephemeral concept of enough. I made air quotes that completely got cut off there, but trust me, without having any real concept of what enough is and what enough looks like. So it's giving that concrete structure to the entire retirement picture and really giving folks the comfort to understand, you know, what's my position at? What can I afford to do? What are the trade-offs I have to look at making? The financial planning process and financial plans are not static. One of the things I tell my clients is the only guarantee I can give you is that absolutely all of my assumptions will be wrong. Inflation will, we've learned this recently, inflation will not be exactly what we assume it will be every year. Rate of return on your investments won't be what we assume. Your spending is never going to be exactly the same year over year. Your goals will change as you age. So we know that all of this is going to be wrong. What we hope is it's going to be close, that a lot of the wrong cancels out, and that it's really giving us more a path to start along rather than a blueprint for the rest of our lives. So best practice with financial planning is that a financial plan should probably be updated about every 3 to 5 years, or if there's a material change in your circumstances. Now, again, some people can get away with not doing this. If you have absolute buckets and buckets of money and all of our work has just been on how do we structure your estate plan to leave your kids their millions and millions of dollars because you've got more than you could ever spend, yeah, you probably don't need to update the plan on a regular basis. You'd have to work hard to not be fine. For the rest of us, making sure that we're on track, or at least making sure that we're making small adjustments as we kind of move off track is really important. But on the flip side, we don't want to be updating this too frequently because we don't want to be like a dog just chasing our tail around the yard. The economy moves in cycles. The markets move in cycles. Again, things we've learned recently if we've forgotten. So this is a long-term plan. We don't want to be overreacting, but we want to stay updated with it. And finally, where do financial planners fit in? I always joke with my clients, I do tax, estate, and retirement planning. I'm not a tax accountant and I'm not an estate lawyer. So my more direct clients will then ask, well, what good am I? Financial planner's job is to be the generalist. It is to understand enough tax, enough estate planning, enough of the intricacies of retirement planning, enough of the intricacies of investment management to really help make sure that all of your resources are marching in the same direction and helping you to achieve the same goals. So a lot of times what I'll tell my clients is part of my job is to help you have better discussions with your other professionals. Here's a list of things I suggest you talk to your accountant about. Here's a list of things as you're getting your will done based on what, I see this a lot, based on the assets that we're looking at and what you've told me your estate goals are. You may want to have a conversation with your estate lawyer. And in my head, I'm thinking, because I'm pretty sure you didn't tell them A, B, and C, which is fair. We don't always know what's relevant and what's material. But part of my job is by asking a wide range of questions is to help get a sense and help you make sure that you're getting the most out of these professionals, as well as bring my own professional skills to bear. So that's enough of me talking about me. Let's talk a little bit about the stuff that you're really interested in. So start with, I've labeled this preparing for retirement, but a lot of this is relevant no matter what stage you are in life. One thing I would recommend to everyone, if you're going to go through the financial planning process, if you're not, regardless of your circumstances, prepare a budget. And there's a couple of reasons for that. One, it's important to understand how much you're actually spending. But two, it's important to understand what you're spending money on. The number of times I've had clients go through the process of preparing a budget to turn around and immediately decide they're not going to Starbucks anymore because they didn't realize the atrocious amount of money they were spending every month on coffee. And these are folks, they could afford to spend the money on coffee. It's not all right, we have to make a sacrifice. and this is the thing we've decided to cut out. It's just they looked at the numbers and like, this isn't worth it for us. It just isn't a good use of money, even though we can afford it. So understanding what you're spending your money on and making sure that that's what you want to be spending your money on. And maybe it'll help you realize that there are trade-offs that you could make, that, you know, you can redirect something that turns out to be expensive and not very valuable to you into maybe something that's more important. One of the things to be careful of is making sure you're capturing the variable expenses in there as well as a budget for what I call extraordinary expenses. Everybody knows this. Something always comes up, right? If you own a house, at some point the washer and the dryer are going to go. At some point you're going to need to do repairs to your roof. At some point the car in the, you know, probably on the Gardner Expressway is just going to stop working. So you don't know what that extraordinary expense is going to be. You don't know exactly when it's going to hit, but they tend to come at a reasonably regular basis. So you want to budget for something's going to happen. You don't have to know what it is, but you want to include that in the budget. A lot of people, when they do their budgets, have a nasty tendency to list out their fixed expenses, right? These are the things I get the bill for, and these are the things I pay on my bill. And I always joke with my clients, I know they haven't been thorough enough if I don't see a line item for the LCBO, because it means that they're just checking out, you know, okay, I paid the hydro, I've paid the phone bill, I've paid the cable bill. Do you go out to eat? Do you know, entertainment expenses, golf club memberships, whatever it is? It's easy to forget about these variable expenses. My best practice is take about 3 months and actually go through and record what you're spending money on for the whole month. Easy way to do that, assuming you pay it off, is to use your credit card, because most of the banks have apps that will actually track what you spend on your credit card or on your debit card and actually just break it down for you. So that's a really easy, you gotta fix some of the stuff it gets wrong, but it's a really easy way to track it. Please make sure you pay off your credit card every month. I don't want word getting out there that there's a financial planner saying just put it on your credit card and let it ride. But it's an easy way to track. But that's my best practice, because then you really get a handle for what you're actually spending your money on, because you're looking at what you spent it on as opposed to what you're guessing you spent it on. And I see people routinely have massive gaps between how much they thought they were spending every month and how much they actually were spending every month. Like I've seen people misestimate it by thousands of dollars a month. And I'm not talking multi-millionaires either. It's kind of insane how quickly the money gets away from us. When we're going through the planning process, we also want to obviously estimate how much we're going to need to spend in retirement. If you've retired, that's easy. You're doing a budget. You're looking at how much you're spending. You haven't retired yet. It's a little bit more complicated. And here's kind of my suggestion for how to do it. Think of your current lifestyle. Now, this is a presentation that's aimed at sort of baby boomers, right? So it's a little bit easier for you because your current lifestyle, even if you haven't retired yet, is probably in the zone of what you want your retirement lifestyle to feel like. You know, when you're 25, you want to be living better in retirement than you're living now. Most of us didn't make a ton of money when we were 25. If you're 64, you might be actually, you know, spending a little bit more than you're necessarily going to spend in the few years after you retire. But around, you know, 55, 60-ish, you're probably right in that zone where your retirement's going to feel a lot like what your current lifestyle is like. Go through what I call the add drop expenses and also the new obligations. And we'll look at that in a second. So what kind of expenses do we add and drop when we transition to retirement? Well, I mean, it's going to be different for everyone, but here are some easy ones. Travel. A lot of folks decide once they retire, they can finally get out and do all the traveling they wanted to do. Other people maybe had to travel a lot for work and decided that they don't have to travel anymore and don't want to do it. So they actually plan on vacation less. There's no right answer, but take a look at how those expenses are going to change. Parents. This is one of the big questions I ask when I do planning that tends to stump a lot of people or confuse them. And that is there anyone other than yourself or your spouse who you think you might have a financial obligation for in the future? A lot of folks I work with end up finding that they're probably going to have to spend some money every month to help mom out. Right? Mom and dad maybe weren't as good as savers, didn't have an opportunity to put as much away. So if you're in that kind of situation where you've got a parent or an adult child with a disability or another family member who's going to be relying on you for income, you have to make sure you budget for that, right? If that's a priority for you and you're going to be helping someone out, you've got to include that in the budget. It also needs to be included in your estate planning. Medical expenses. Medical expenses and long-term care kind of lump together a bit because they tend to go hand in hand as we age. Obviously, as we age, our body starts to break down a bit. Our medical expenses get higher and higher. We want to make sure we do some budgeting for that. Before I did this presentation, we were first talking about it. Alan was really gracious enough to spend some time with me to talk a little bit about your community and about some of the needs that were kind of, well, I don't want to say unique, but might be more relevant to your community than who I would normally talk to. And one of the things that he called out was you may have higher medical expenses. So this is something I think, especially for the folks I'm talking to today, that you really want to make sure you've included in your budget and that you're prepared for. Children, education. Depending on your age and when you got started with your family, that may mean that either you're about to start paying for your children's education as you enter retirement, or you're about to stop paying for your children's education as you enter retirement. And depending on your children and the situation, it may also mean that they're moving out on their own. They're paying their own way at this point. So these may be significant expenses that drop off for us right around the time we enter retirement. Same for the mortgage. If you own your home, a lot of folks, the mortgage starts coming off right around the time you enter retirement. And that's a huge chunk of money that, a huge monthly expense that just disappears, that kind of frees up capital for other things. The last one is savings. Hopefully you've spent a good chunk of your life putting money away every month so you can support your retirement. Well, once you hit retirement, you're not saving for retirement anymore. So that's actually an expense that disappears. You're going from adding to your savings to drawing on your savings. So it's important to consider that because that actually does free up considerable amount of money, to be honest. So let's look at our major sources of income. Canada Pension Plan. I didn't put an estimate in there because it really does vary for everyone. You can log into your CRA website if you've set up access, and they can actually give you an estimate of what your CPP payments are going to be. Old age security. As of this year, it's going to be about $685.50 a month, up to age 75, and then going up to $755, give or take. But OAS is, unlike CPP, OAS is clawed back, which means starting at just under $80,000 a year, if you're earning more income than that while you're receiving OAS, they will start gradually reducing the amount of OAS that they still pay you the same amount. They just want some of it back when you file your taxes. And if your income is up over $129,757 a year, you're not keeping a dime of your OAS. Not necessarily a bad thing. If you're making $130,000 a year in retirement, it means you've put away considerable assets throughout your life. So it's not necessarily a bad situation, but it is something to understand. It is something that in some circumstances can be planned for and may affect some of your retirement planning, and it is something to be aware of. RRSPs, TFSAs, which I'll go into in more detail in the next couple of slides. Non-registered accounts, which is just where you save any money you have that you can't fit in your RRSP or TFSA. If you're fortunate enough to have a pension plan, you're going to be getting that. And income from annuities for anyone who's receiving that. There are other sources of income, but I kind of wanted to hit on what are the most common ones and typically the biggest ones. So let's take a look at the Registered Retirement Savings Plan / the Registered Retirement Income Fund, popularly known as the RRSP and the RRIF. So just quick overview of how the RRSP works. Income tax is deducted when you make a contribution. So essentially what happens is if you put $1,000 into your RRSP this year, your earned income gets reduced by $1,000. And in that manner, it reduces the amount of tax that you owe. When you take money out of your RRSP or later on your RRIF, that money is treated as income. So really what that means is that the RRSP is a tax deferral vehicle. You're putting money in and hopefully deducting those contributions while you're working and paying a pretty high tax rate. And ideally, you want to be taking the money out in retirement and at a lower tax rate. It still works if you're going to be in the same tax bracket, but you do get a distinct advantage if you're able to take the money out at lower tax rates in retirement. So that is one thing to keep in mind, especially if you're looking at whether to put money in an RSP versus a TFSA, is having a bit of a handle on, well, how much will I be paying tax, do I think, when I take it out? The year you turn 71, you convert your RSP into something called a RRIF. It's basically an administrative process that you shouldn't have to worry about, because whatever the financial institution where you have your RSP, they're going to send you a bunch of documents. They're going to insist you sign them and send them back. Nothing else happens. It's the exact same investments. Whatever you held in the RSP, it basically just changes the account name and the account number. It's a bit of a nothing burger. The one thing to keep in mind is that you do have to start taking out minimum payments starting the next year. So the year after you turn 71. Not a bad thing. For most of us in retirement, we'll probably be taking more than the minimum amount. You can take out as much as you want from your RRIF. There's no, for a regular RRIF, there is no maximum amount to take out, but whatever you take out gets added to income. So you probably don't want to take the whole thing out the first year after you retire, because you're probably going to take a pretty big income hit that year, and you're going to be going up through all those tax brackets. As I said, it's best if the income is going to be lower in retirement. The other thing to keep in mind is there is an income inclusion on death. So when you die, and I'll get into all of the wonderful things that happen when you die in a little bit, but one of them is that the money in your RSP or your RRIF is basically treated as earned income the year you die, unless you have a surviving spouse, in which case you have the ability to roll this money, essentially transfer it into your spouse's RSP or RRIF, where they can create one to transfer it into. So all of that gets delayed until this, the death of the second spouse occurs. So that's a really, really important planning point and incredibly helpful for families in retirement. The tax-free savings account. Now, I just want to take a quick aside. At the beginning of this, I said there were virtually no things that were absolute in financial planning. Here's one of them. If you've maxed out your RSP and you have a bunch of money sitting around that you know you're not going to need this year, and you have room in your tax-free savings account, put it into your tax-free savings account. I don't need to know anything else about you. I don't care what you're investing it in. Doesn't matter what you're going to do with it. It's just a win. It's one of the very few things that is just a simple, this thing is good. And it's really good. Now, the thing is, unlike with an RSP, there's no deductions for contributing, and you're not taxed on anything when you take it out. So whereas the RSP is a tax deferral vehicle, a TFSA is really a way of earning growth tax-free. So it is a pure, tax-free vehicle. It's named appropriately. Additionally, when you take money out of a TFSA, you can put that money back in the next year. So withdrawals actually get added back to your rooms in subsequent years. So, excuse me, this makes it an excellent vehicle for saving for the medium term. If you've got a big family vacation you're planning on taking in 5 years, putting money into your TFSA to allow it to grow a little bit and not have to pay tax, and then planning on taking it out in 5 years, that's a great way to do it. Saving for a car, it's also a fantastic retirement planning vehicle if you don't have these shorter term plans. But unlike the RSP, where you don't get the room back if you take money out, and you certainly don't want to be taking money out when you're working because it's just added to your tax brackets, the TFSA works very well as kind of that shorter medium term savings vehicle. And when you die, the money just gets paid to a beneficiary or to your estate. There's no tax trigger on death either. One of the things I'll actually suggest to people while they're working is some of my clients get a bit of analysis paralysis. They say, I can't decide whether to put money in my RSP or my TFSA. What do I do? What do I do? I don't want to do anything. And you'd definitely rather have the money growing tax sheltered throughout the year. You'd rather not wait till December to make the decision. So one of the things I suggest is put the money in the, as long as it doesn't go over your TFSA limit, put the money in the TFSA every month. When December comes around, you can decide whether it should stay there or whether it would be better off living in your RSP. take the money. If it should go in the RSP, if it should go in the TFSA, it's already there, so your job's done. If you decide it's better to put it in your RSP, take the money out, contribute it to your RSP, and then next month in January, that money you took out, you get that room back. So it's a great way of kind of being able to push off the decision and still maintaining the flexibility. Whereas let's say that, you know, the washer and dryer break and all of a sudden you're like, oh, I can't save as much this year. I need access to some of that money. It's easy to take it out of the TFSA at any time you need it. So, you know, we talked a bit about how to save and where to save. There are limits, right? So we're either entering retirement, we're approaching retirement, we're in retirement, and we need to stretch our assets. What are our options? Well, if we haven't retired yet, saving more money is always a good way of having more money available for retirement. Reducing your retirement expectations. One of the big ways of stretching your money in retirement is spending less. It's, you know, not the most exciting option, but in a lot of cases, it's the best alternative. Delay retirement. If you haven't retired yet, you get a massive bang for your buck off of pushing off retiring by a couple of years, because not only is it a year, you know, for every year you delay retirement, not only is it a year less that your retirement assets have to cover you, but it's also an extra year you get to save for retirement. So it really does double duty. Of course, the downside is you're putting off retirement, which isn't super palatable to most folks. You can downsize. You know, this is one of the things that tends to be fairly common is folks say, okay, the kids are moving out, we're saving some money there. We don't need the house that's quite as big. So maybe we're going to be able to move to a smaller place. And this is kind of one of the other areas that Alan pointed out to me that I think bears some specific commentary for this group, is that I understand, and rightly so, that you know, when you move into an apartment or you purchase a home, there's probably going to be more renovations that occur than occur with a lot of other folks. You know, obviously, and this makes sense, you want a home that is comfortable, that suits your needs, that is, you know, that is really your home. So there's probably more accommodating renovations that need to occur. That's going to increase the cost of your home. And because those are things that tend to be more unique to your community, it's probably going to impact the resale value a bit as well. Now, I'm certainly not saying not to do that. What I am just saying is when you're doing your long-term planning, you have to account for that. Housing costs are just going to be a little bit more stretched on both going in and coming out when it comes to downsizing the home, you know, for your community than it's going to be for a lot of other folks. So it is something just to keep in mind. And then, of course, this is one of the areas where I see a lot of bad ideas, and I'll call out two of them so you know not to do them. One is people say, well, I'll just invest more aggressively. As we all know, the more risk you take in investments, generally the higher your anticipated return is. But taking more risk than you're comfortable with is a terrible idea. What we found through experience is that people who invest outside of their risk tolerance tend to panic when the markets do what the markets have been doing recently, and will tend to go to cash at exactly the times they shouldn't be. And making those kinds of emotional decisions with finance is never good. So it's very important to continue to invest within your risk tolerance. Taking, you know, it's just, I'm going to be more aggressive is generally just not an answer that works. The other thing you should not do that I will not include in my plans, except under very specific circumstance, is relying on inheritance. There's just too many unknowns. You don't know how much it's going to be. You don't know when it's going to come in. You don't know if it's going to come in. You know, if dad passes away and mom all of a sudden decides that she is really, really fond of the guy who cleans the house pool, and all of a sudden they run off to Acapulco together, well, you're in a lot of trouble if you banked on mom's money supporting your retirement plan. The other thing is, the last thing I want is for somebody to be sitting around at Thanksgiving going like, okay, we planned on mom dying at 87. She's 92 and my retirement plan's in a lot of trouble. Like, I need to hear her cough, or I don't know what I'm going to do. I don't want people in that situation. So, except in the situations where a parent has already passed away, or a parent is, in the process of dying and the estate is simple, I generally just refuse to include inheritance in a financial plan. I think it's a best practice. It's not something you should ever rely on. So now we get to the really exciting stuff, tax planning concepts. This is where I highly suggest that everyone go get a cup of coffee because it's going to be fun. I'll try and get through it pretty quickly and keep it to stuff that I think is generally very relevant to a large group of folks. So for registered accounts, one of the big ones is that you can split RRIF income and pension income with your spouse. So it's you know, if one of you has a larger RRSP or RRIF than your spouse, you know, maybe one of you, you know, worked and the other one stayed home to take care of your children or what have you, or just worked at jobs that had different levels of income, understand that you can split this income. So that's a way to equalize payments between spouses. And for most of us who are really relying on TFSA income, RSP income, CPP and OAS to support retirement, that basically means you get to balance out all your income in retirement, which is incredibly powerful. You can consider converting a portion of your RSP to a RRIF at age 65, even if you don't need the income, because you can qualify for a $2,000 a year pension income tax credit. Now, by the time you actually figure out what that's worth to you, I think it's about $500. But hey, if you owe the government $500, they make sure to take it from you. So it's not necessarily a bad thing to do. Certainly something to consider. And then there's a slightly more complicated strategy, which involves early or extra withdrawals from an RSP or a RRIF, basically taking out money after you retire generally, but taking out more money than you need, or maybe taking out money before you necessarily need it. And this can be done for a couple of reasons. One is estate planning. Because as we said, you know, RSP RRIF income is brought into income when you die. So this is a lot of times people's largest asset, taxable asset when they die. And if you take the money out in earlier years, you might be able to take it out at lower tax brackets. So there is potentially an advantage there. The other thing is your RRIF minimums eventually climb larger and larger, and they could potentially build into OAS clawback territory. So if you take some money out earlier, you may be able to stay under or lower in the OAS clawback territory for more of your retirement, which could potentially leave a lot more money on your table. The problem with this is, as far as I'm aware, there is no easy way to estimate whether or not you should take money out early from an RSP or RRIF. I've been doing this for 10 years. I like to think of myself as a bit of a math nerd. I have no idea how to ballpark it for people. When I'm dealing with clients, I put all of the data into a financial plan, and I will run scenarios on a financial plan to try and figure out which option and, you know, kind of when and how much withdrawals looks optimal. And that's the only way I can do it, is kind of the brute force method of getting this information out of the software. So yes, we can absolutely do that analysis for you. I just can't give you any framework for how to do it for yourself. And if it's out there, please let me know. The other big kind of tax planning concept for a lot of folks, and again, this is, you know, largely for married people, is other forms of income splitting. So the big one that you may have heard of is called the spousal loan. Typically what this is for is if one of you has a significant amount of non-registered money that's invested, that's earning income, and it's really, you know, the two of you are in different tax brackets, significantly different. The person with the non-registered money is in the higher tax bracket. This can come from the fact that, you know, maybe they were a higher income earner and saved more non-registered. It could be from the fact that they had an inheritance. Maybe they own property prior to marriage that they've sold, you know, and it could come from anywhere. So what happens is you actually create a formal loan from the higher income spouse to the lower income spouse. It has to bear an interest rate of at least what is called the prescribed rate, which is currently 3%, and that's set by the federal government. That interest has to be paid annually. This is not something you can yada, yada, yada around and say, well, let's assume we did it. The interest has to be paid from one spouse to another. The interest is tax deductible for the lender, and it's taxable income from the borrower. And the idea is that what you do is you make this loan, and because you've done it as a loan with the prescribed rate of interest, let's say I've got $1 million of non-registered money and my spouse doesn't have anything, and I can lend her $500,000. She can invest that money. Any income off of that money is now taxable in her hands. because that loan carries, if I just put 500,000 in her name, all of that money would be attributable to me. You can't just put money in any spouse's name or throw money into a joint account and split the tax on it. It has to be traced back to who actually earned the money. So by using this prescribed rate loan, it does give you a legitimate CRA approved way of taking a large chunk of money and having the other spouse earn and declare the income off of that money. Now, you're going to want a loan agreement structured. You're going to want accounting advice. You may want a lawyer to draft the loan agreement, because the higher income person is going to be declaring this prescribed rate interest as income. It is a bit of an offsetting impact. This isn't something you're going to do with a difference of 20,000 or 50,000. This is, I don't want to put an exact number on it, but I probably wouldn't look at a spousal loan for less than 250,000, maybe probably even more. It's just not worth the effort. And below even that, you're actually going to get negative results from it, especially what we now have as the higher prescribed rates. The much simpler option, less robust, but simpler, is simply look at how your family allocates savings and expenses. The higher income spouse can pay all of the family expenses. They can pay the mortgage, they can pay the hydro bill, they can pay, God help you, the Rogers or the Bell bill, all of these things. And then the spouse, and this assumes that you're maxing out your RSPs and your TFSAs already. But in that case, the lower income spouse can then save money in the non-registered account, which is taxable. Because they're in the lower tax bracket, they're going to pay less tax on it than if the higher income spouse was saving that money. So that's an easy, no paperwork, no accountants necessary way of splitting income. You can do it at much lower dollar values, but there is a threshold, right? If you still have money available in your RSP or your TFSA, make use of that first. It just makes more sense. And finally, I want to touch on spousal RSPs. They are a thing. They do exist. They were originally created before you could split RSP income. That's I want to say relatively new, but it's not. I'm just getting old and I've been in the business for too long. But 20 years ago, you couldn't split income between spouses on RSPs. So spousal RSPs made a ton of sense. There's nothing wrong with them now. They still exist. There are still niche uses for them. But don't feel you have to make use of them. Most folks are not missing out if they don't take advantage of them. But if your financial advisor or your bank has set one up for you, there's not really a downside to them either. So they're a little bit neither here nor there, but there are some niche uses for them. Just don't feel like it's really a compelling thing you have to worry about one way or the other. Now I'm going to get to the fun part of the conversation. What happens when we die? First of all, we get to the other thing, which I don't need to know anything about you to tell you. You need a will and powers of attorney. Yeah, I know it's going to cost $750, $1,200 somewhere in there, depending on where you live. It's worth it. Please pay it. I'm begging you. You're not going to care. By the time it's relevant for you, you'll have passed away. But if there's anyone in your life you care about, you do not want them at the time they're grieving for you to have to go through the trouble of being declared, what's the term in Ontario? Estate administrator for a state without a will or something. Applying for probate is bad enough. Applying for this is just a real pain in the behind. It's manifestly unfair. Most lawyers, the same time they will do a will for you, will also do powers of attorney, which you should have regardless. This is what's colloquially called the living will. What happens with my medical care? Who has authority to make decisions? What decisions do I want to be made? All of that can go into what's called a power of attorney for personal care. The power of attorney for property is just if I'm incapable of making financial decisions, I authorize somebody to make decisions on my behalf. Very frequently, it's done as a spouse. And the nice thing about these is they can be set to be called what are called springing powers of attorney, which means they basically don't exist as long as you have capacity. And then as soon as you lose capacity, that's when they become enforceable. But they're very, very helpful. And I cannot recommend enough. Everybody should have wills and powers of attorney. Something else to keep in mind in Ontario, people always say these days, marriage is the same as common law. I'm sure you've heard that a lot. Not if you die without a will in Ontario, it's not. If you die without a will in Ontario and you are common law, you have no rights under Ontario's intestacy laws. So you absolutely want to make sure if you're common law as opposed to married, you have wills, because it's the only way your generally the only way your partner is going to be properly taken care of. On your registered accounts, your RSPs, your TFSAs, you have the opportunity to make beneficiary designations, which basically says this person gets my money if I gets this money if I die. Very, very helpful. It keeps the money from falling into your estate, which protects it from estate creditors, protects it from probate, which is a fee the government charges to manage, not manage, to put a stamp on your will. Allows for a much more orderly distribution of those assets. Generally, your spouse is your primary beneficiary. And as we said, these assets can roll into their plans on a tax deferred basis. So it's a great thing to do. When you're looking at planning your will and your estate, I tend to tell people there's two important dates you want to look at. One is what happens if I die at my expected mortality? The other is what happens if I die tomorrow? Because those can be very different plans. And a good lawyer can help you structure a will that covers all those eventualities. You may say one of the classics is, well, my house is worth $1 million, my RSP is worth $1 million, so I'll leave the house to child one and the RSP to child two. Well, even that has some problems with the way the RSPs are taxed on death. But even ignoring that, that's great if you die next week. What if you live another 30 years and you've drawn down your RSP till there's practically nothing in it, and your house has been growing at 5% a year? Child one loves it, they get the house. They're thrilled, they get basically your entire estate. Child two gets nothing. Or the little amount that's left in your RRIF account. So it's very important to, talk to a lawyer. I'm not a big fan of do-it-yourself wills. I think it's much more important to be able to plan these things out and get professional advice. One of the things I love doing is just drawing a chart. And along the left-hand side, list all your assets. And along the top, list the beneficiaries and who is going to get them or who you want to get them. And then the bottom, you can add up the columns and make sure that the amounts that you're actually anticipating leaving to various people accurately reflect what you want your estate division to look like. Because I've gone through that exercise with tons of people and they were stunned to realize that they hadn't balanced their estate distribution in the way that they'd wanted to. And it doesn't mean that it has to be equal, but it should reflect your goals. So what happens with tax on death? I'm going to move through this a little bit quickly because I know I've already taken up a chunk of your time here today. Well, there's a deemed disposition on death. So you are deemed to have sold all of your assets at their fair market value the day you die. That includes an income inclusion on RSP or your RRIF. So whatever is in there, it's basically treated, the total value of it is treated as income the day you die. Now, your home is deemed to have been sold as well. However, for most of us, we're going to get the principal residence exemption on our home, which means that it's probably going to be tax-free. And that principal residence exemption applies on death. So typically, you're not paying any tax on the value of your home. For most Canadians, their biggest taxable asset on death is going to be the value of their RSP or their RRIF. And pretty much all of your assets, if you leave them to your spouse, can be rolled to the spouse tax deferred. So really, there's virtually no tax payable on the death of the first spouse in a lot of cases. However, we do have probate. So what is probate? Probate is a stamp that the government puts on your will that says, yes, we've probated the will. In Ontario, the government will charge 1.5% of the value of your estate over $50,000 for the privilege of putting the stamp on the will. Do you have to have it? In most cases, yes, but not necessarily. When my mom passed away, I didn't probate her will. Everything she had either had my dad as a designated beneficiary. Basically the only asset in mom's name alone. There was a joint account which rolls automatically to dad. The only asset in mom's name alone was one car. And in Ontario, if they see a copy of the will and it's under a certain value, which this thing was, it was like a 3,000-year-old Volvo. They'll just transfer the ownership to the spouse without probate. So there was no need to probate the will. However, if you have any assets where somebody is going to want to see a stamp that says, this is the valid will, the person talking to me is the executor, I can rely on this information to transact with them, then you're going to need probate. So what do you need probate for? If there's any investment accounts without beneficiary designations that aren't joint, so solo bank accounts, the banks typically have a de minimis rule, but of any substantial value, the bank's going to want a probated will to transfer that asset. When it comes time to sell the house, you're not going to be able to sell and transfer ownership without a probated will to show that, the owner has died. You're legally allowed to sell the house on behalf of the estate, and it's all legitimate. Like no state lawyer is going, or no real estate lawyer is going to handle the transaction without that. So for the most part, you need to go through probate. It's going to be 1.5%. There's a lot of stuff that you can keep out of probate by keeping it out of your estate, joint assets, beneficiary designations. If you nominate a beneficiary of your life insurance, all that keeps assets out of probate. My head is covering the word lawyer down below. This is awkward. I need my head a little rounder and less pointy. One of my big advisories here, there are a lot of professionals who think they're doing people a service by suggesting, well, just put your assets joint with one of your kids so that they get the money when you die and the money skips probate. I put here nicely, don't do it without consulting a lawyer, and that is 100% true. I have yet to meet an estate lawyer whose recommendation is not just flatly do not do it. Don't ever. It's not worth it. 1.5% of the value of your assets, hopefully 20, 30 years from now when you pass away, and it once, not every year, it's 1.5% once, is not worth the potential problems that come with putting someone other than your spouse joint on your accounts. What are some of those problems? Well, if that person gets divorced, their spouse might have a claim that this asset is not family property for their family. Creditors, if your child who you've put on joint develops some kind of addiction issue, gambling, drugs, what have you, gets into financial trouble, bank's going to let them take the money. You've put them on joint, you've told the bank they're co-owners, so you're opening it up to even those kinds of issues. And finally, it gets really legally complicated after you die about who actually owns this money. Most people think, well, it's joint with rights of survivorship, so the person who's on joint gets the money when they die. That is not the basic assumption in Canada. If anyone's really bored and feels like reading anything, the controlling court case on that was PCOR, which was a Supreme Court Canada case, and it basically said that's not the assumption we make anymore. We assume that this money is being held in trust for the estate. So it can get very complicated, very messy, very quickly, and I can almost guarantee you your estate will spend more money on lawyers than you'll save in probate. Couple of misconceptions or just final comments about estate planning. There is no estate or gift tax in Canada. There's probate, there's deemed disposition. There is no estate tax. This isn't the States. We don't tax the value of your assets when you die. We tax the income inclusion. Assets can be gifted, my fancy Latin phrase here, ante-mortem, before you die. Yeah, you can absolutely save probate by giving stuff away before you die. Question is it worth it? The big trick is anything you give away before you die is something you don't have anymore. So yeah, if you've got tons of extra cash and you want to give some to your kids and watch them enjoy it, go nuts. But if you're worried that you're still going to might be a little bit tight meeting your retirement goals, I think you're better off making sure you have your money to spend than you are trying to do early probate planning. Certain assets, like private company shares is the big one, in Ontario can pass via secondary will and actually escape probate. I can talk more about that offline if anyone's interested. A final comment, you've got a couple of decisions to make when you're planning your wills. Fair versus equal. If you have two kids, one of them is a doctor and that doctor is married to an engineer, and the other one maybe didn't manage to graduate high school and has been struggling financially, you have to decide how you want to divide up the money. Maybe it's 50-50 between the two kids. Maybe it's more to the one who's struggling financially. Or maybe it's more to the one who's been successful because the one who's struggling financially is just going to use it in ways that might actually hurt themselves. I don't have a right answer for you. These are very individual decisions, but this can be a decision you have to consciously make in certain circumstances when you're going through your estate planning. Be aware of it and understand it's something you've got to address, at least yourself. How important is it to leave a legacy? A lot of the clients I work with, their entire estate goal is my kids will get whatever's left over. My money exists to help support me in retirement. That's my goal. And whatever happens to be around when I pass, they should be happy they didn't have to have me move into the, move into their house and take care of me. So if there's anything left over when I pass, that's what they get. That's completely fine. That's an absolutely legitimate way of doing your estate planning. Charitable donations. Understand what your goals are. Take a look at timing. Leaving, if you have charitable intent, leaving money through your will isn't necessarily always the most tax efficient way to do it. It might be better to do it over a string of payments throughout the years, but not necessarily. And the nice thing about leaving money to charity in your will is you don't need the money anymore. So again, it can be conversations, part of a financial planning conversation. One thing I will point out, because I see even financial planners talk about this and it drives me bonkers, making a charitable donation is not a tax saving strategy. Yes, charitable donations are tax deductible, but you will not get more tax savings than you make in a donation. So you're always going to have less money in your pocket. If your goal is I want to hold on to more of my money, making a donation to save tax doesn't work like that. But if you have a charitable intent, then yes, get the tax deduction allows you to, either pay less tax or give more or whatever you want. So it's important that the intent is there. It's not a pure tax planning pay. I cannot save you more money in tax than you spend in donations. And finally, I've left my contact info up here. I know I've kind of stretched the limits of how gracious you all have been with giving me your time. I'm happy to stick around for questions, but I'm also, thankful enough to Alan to invite me to speak to you today. That if anyone wants to take down this information, or Alan has it all as well, and wants to just ask me questions offline or discuss it further, I'm more than willing to have those conversations with you. And I promise you won't. If you want a full financial plan, that is what I do for a living. So I do charge for that, and I'm happy to do it. If you want to have, a bit of an offline conversation, though, I'm not going to send you an hourly bill. I'm happy to have those conversations. Alan's been very gracious with me and letting me talk to you folks. So, this is kind of my way of paying it forward. With that, I'm happy to take some. I understand we were only supposed to go till 2:30, but I'm happy to stick around for a bit if anyone's got any questions.
Okay, Vince, what I'm going to ask here is just when we stop sharing for now, and I'm just going to open it up.
Sure. How do I stop sharing with it? Oh, there we go. Okay. I used to be good at technology, honestly.
Okay, so what I'm going to do is thank you very much for spending the time with us and teaching us so many things. We hear a lot of these things, in the media, online, or in newspapers, or whatever we get. And sometimes it's better to see it hear it in person, yeah, and see some of these things. And so thank you very much. It's all very important.